Smriti ma'am, good evening. Am I audible to you?
Yes, ma'am. Good evening.
Good
Yes,
evening.
you are audible.
Today, very few have joined. I think they are
Yeah,
enjoying
they'll
some.
join. They'll join in a bit because I forgot to remind them in the group
Oh,
today.
you remind them every day?
Yeah, I remind because there is a difference.
Okay.
So uh, I'm going to remind them again. I think they'll join soon. You can start, and Farida is also co-host. She'll help you.
Okay, ma'am.
Yeah.
They are joining. Slowly
Yes.
they are
Yes.
joining.
Yes. Yes. Okay.
Okay. So I'm starting. Okay.
This is your last class, or one more class is to be
Ma'am,
there?
this is in continuation of four classes. This is the last one. One class you told you will be scheduling at the end because
I
18th
think
one I was
it's already scheduled on 19th, I think.
okay, but I have not received that mail.
Mama sent you.
Okay, I will check, ma'am. Today only you sent?
No, no, that day, the very first day.
Okay,
Don't
okay.
worry. Check. You
No,
check.
ma'am, it was scheduled on 18th now, but I asked you to cancel.
Yes, yes. Later on, I scheduled it, but I need to check it.
Okay, ma'am, I will also check. Okay, ma'am. Then I will let you know.
Yes, you can start, ma'am.
Okay, ma'am. Thank you so much. So I think this is visible to you. Just let me know, students. Is it visible?
Yes.
Yes.
Yes,
Yes,
ma'am.
it's
Can see.
visible.
Yes, yes, ma'am.
So today we are starting with the block 4. And when we start with the block 4, it is financial statement analysis. And in this financial statement analysis, we are going to see how the company looks into the accounting or financial statements from the perspective of a company or from the management side. So when you start with block 4, the first one that you get, the first unit or chapter, whatever you call, it is understanding annual reports. And when we talk about understanding annual reports, this is the theoretical part. We don't have anything to do with the practical for this chapter. Later on, when we move to the next unit, 13th and 14th, it is ratio analysis. And the last one, it is your financial statement analysis based on common size and comparative statement. So we are starting on a lighter note with understanding annual reports. Now, what are annual reports? All those reports which are prepared at the end of a financial year and they are submitted to the management for major strategic decisions. They are known as annual reports. By the name only you can understand it is annual, so it is prepared on annual basis at the end of the financial year. So when we talk about the contents, it contains information about the firm's business and obviously the financial position of the business and the performance of the firm. We can get many informations through these annual reports, and these annual reports are very much helpful to all the stakeholders, to the government, to the researchers, to the students, and of course to the management. So when we talk about the usefulness of this annual report, the various stakeholders, as we have discussed, they want to view the company's annual report in the process of decision making. So, when we start with what is actually an annual report is about. So, it is a document which is publicly published. There are many reports, but those reports are with the management, with the company. Annual reports are the reports which are published, which are for public. It is available in public domain. And when we talk about a limited company or a listed company, they, it is mandatory for them to publish the annual reports. So this annual reports it describes about the company's operation and financial performance in a detailed manner. It is a combination of information represented by graphs and pictures. So, what are the contents? The contents can easily be seen in this flowchart. It contains non audited information. It contains financial statements. Financial statements, as already we have discussed, it is your trading account, profit and loss account, and balance sheet. It is notes to the accounts. When we see the financial statements are only the gist, the summary. But what is actually, if you say that the position of your assets for a particular period is 5 lakh. So this 5 lakh is due to purchase, due to sale, after depreciation. So the detailed information is available in the form of notes, then accounting policies that is followed. We also have our cash flow and fund flow statement in the annual report and some other information which are given as a remark. So all these informations are available on the public domain. We also have a chairman's statement. We have the auditor's remark, the address of the firm, its area of operation, a description of the principal activities of the company, the employee statistics, name of the directors and their interest. There is certain information related to the operation of the business, how you are going to distribute the profit. Are you going to distribute it in the form of dividend or you are going to retain the profits? It also reveals the financial position of the business, the capital structure, like what is the position of your firm in the form of equity and debt. So these are all contents of your financial statement. There is a detailed auditor's report also available in the annual report. The detailed auditor's report contains the independent internal and external auditor's report. The auditor's report is again important because banks, creditors, they require an audit of a company to be done, and the financial statements should be audited before funding these firms. So the auditor shall make a report to the members of the company. So that it is the mandatory duty of the directors to get the accounts of the company audited every year by qualified auditors. When we talk about qualified auditors are the persons who are expert in the field of accounting. That is, they should be chartered accountants. So these auditors are appointed by the shareholders, though they are appointed by the management, by the shareholders, but they are independent auditors. The company's management do not have any hold on them and they can reveal the company's financial position independently. So it is the duty of the board of directors to attach the auditor's report to the balance sheet and provide a copies of auditor's report to every shareholder of the company. So this is what actually annual report is about. Now if we come to the next topic of this, financial statements we have covered. It is profit and loss account, balance
Yeah,
sheet.
madam.
Yes,
Yes, please, can you increase your Zoom size, please?
just let me know, is it visible?
Yes, yes, thank
Is it visible now?
you. Yes,
Okay, Bora. By the time you also, I prefer that whatever subject you're referring to, you should also have a handy printout, or if it is available in the soft copy, okay? Because we scroll very fast. Okay, coming to the next. This we have discussed what are the notes, what are the contents. The, the annual report also contains the details of the fixed assets and share capital that I already told you about, the capital structure of the company. it is share capital, then the information related to earning per share. Now, what is the difference between annual reports and public company and private company? The first important difference is that the annual reports of public company needs to be published. It is mandatory that they have to publish the annual report. There is no such obligation with the annual reports of private company. So the three main differences which is highlighted here is that in case of private companies, the annual report is prepared following section 134 and other applicable provisions of Companies Act. This I'm talking about the Indian Companies Act, where for public companies, the annual report is prepared with the regulations of 34 and 30, 32 and 34 and Schedule 5 of SEBI's. SEBI's LODR. LODR is Listing Obligations and Disclosure Requirements Regulation. SEBI, it is an statutory body in India. Its full form is Security Exchange Board of India, which looks after the issue of securities. So any company which deals with public subscription, which issues shares in the market, they have to compulsorily publish their reports in the public domain. So listing is registering yourself with the stock exchange. The second difference is that one whose stock is not traded in the open market is usually a document that gives just the mandatory information about the company performed in the past year. That means private companies' shares are not traded in the open market. So they can only give a document which will be an information about the past performance of the firm. But when we talk about the public companies report is often loaded with lots of information related to the issue of shares, its subscription, authorized capital, and this is very much useful for the potential investors and creditors. The third difference is that the annual report for a private company doesn't always have its financial statement audited. It is not mandatory for the private company to get its financial statements audited and bring it to the public domain. But when we talk about the public companies' financial reports, annual reports, it is mandatory for them to get the financial statements audited and publish it in the public domain. Am I clear till this?
Yes, Professor.
Yes.
Okay, others also?
Yes, it is.
Okay. Okay, thank you, Grace. Now coming to the next annual report for a government company. What is the annual report for a government company? The central government or the state government, they are the members of a government company and their report should be prepared within 3 months of its annual general meeting, before which the comments given by the Comptroller and Auditor General of India. So, after the final annual general meeting, they have a AGM at the end of the financial year. So, after the AGM, it is mandatory for them to publish and prepare their annual report within 3 months. As soon as maybe after such preparation, it has to be presented in both the houses of the parliament with a copy of the auditor's report and its comment. It should also have the comments from the central or any state government which is a member of the firm. Next, we start with Green Annual Report. This is a recent addition nowadays. Just like a normal annual report, a green annual report is a comprehensive document that contains information on a company's financial position and performance over the preceding year. The major difference between a normal annual report and a green annual report is that the latter is printed using production processes that save energy, trees, and water, as well as reduce waste and greenhouse gases. So, it has been studied that trends in annual reporting, the average number of pages in an annual report was 65, and the number of copies produced averaged between more than 5,000 to less than 50,000 copies. So, green annual reports are frequently printed using eco friendly soy inks in comparison with traditional petroleum based ink. Soy inks are environmentally friendlier and are available in brighter colors and make it easier to recycle the paper. An eco audit statement is placed in the final document that estimates the number of trees preserved, pounds of water borne, waste that was not created, number of gallons of wastewater flow saved, pounds of solid waste not generated, net pounds of greenhouse gases prevented, and the amount of energy in million not consumed. So, a green audit or a green annual report uses eco friendly inks, and the auditor has to also submit an eco audit statement about the savings or how they have protected the environment with the publication of annual reports through green audit. So, this is the end of this first unit. The key words that you come across in this chapter is annual report, auditor. Auditor is a qualified person expert in the field of accounts. He is well versed with the company's rules, policy, structure, and the law related matters. Basically, he is a chartered accountant. Board of directors, everyone knows what it is. Corporate governance. Corporate governance, it is the combination of rules, processes, or laws by which the business is operated and controlled. ESG, it refers to the three central factors, namely environmental, social, and governance. It is measuring the sustainability and societal impact of an investment in a company or business. And green annual report, the annual report where we are using or printing the report using production processes to save the energy, trees, water, and also reduce the waste and greenhouse gases. So, this is all for first chapter of this block related to annual reports. Now, just think and let me know, was it clear or you need any explanation for that? I hope this was the most easy chapter since we have started our classes. Yes, Samsuddin, you want to say something?
No, I'm not saying anything.
Okay. Others?
Like you said, it is the most user friendly blog so far.
Yeah.
So it's
But
understood.
only, but Grace, only this chapter, not the block. When we are coming with the next one, we are commencing with the next one, ratio
Okay.
analysis. It is again full of
Okay.
formulas, all accounting
Okay.
formulas. Only this chapter was user friendly and easily understandable. Bora, is it clear? And what about Chipulu Mutsu?
Yeah, it's clear for me, madam.
Okay. So we are starting with the next one. It is ratio analysis. Under this ratio analysis, we are going to study profitability ratios, liquidity ratios, leverage ratios, coverage ratios, efficiency or activity ratios, investment ratios, and the keywords which are used in this chapter. So when we start with ratios, we know what is the financial statements. Financial statements are only giving you the information about the investments, about the assets, about the liabilities, about the income and expenditures at a given point of time. But if you want to study the performance of the firm, the present position of the firm, if you want to compare the firm's different assets, liabilities, income, sales, production, then it is not possible with the help of one particular statement. So, when we talk about the comparative study, we talk about analyzing the statements, we use ratios. Ratios are mostly expressed in terms of percentage, and it is the analysis of financial statements. When we want to study the relationship between any two or more things which is given in the financial statement, we use different types of ratios. So, when two or more items of the financial statements are studied, they are expressed in ratio, and these ratios are called as financial ratio. If we want to comment on the performance of the firm, then we are going to study about the production, about the sales, about the expenditure, and this we can say that when the expenditure was high, when it was low, when the sales was high, is your expenditure justified with the sales, with the production? So all this type of study is very easy with the help of financial ratio analysis. So in order to evaluate the performance of a firm in terms of its profits, not only knowing the quantum of profit is important, but we also need to know the different relationships of this profit with, with other variables or components in the firm. So when we start with the types of ratios, this is the flow chart. Types of financial ratios. The first one is profitability ratios. You can easily understand what is profitability ratio. This talks about the profit of the company. Profit is expressed in terms of sales. So we are going to analyze the sales with different components. Liquidity ratios. Liquidity means the cash. How much liquidity a firm has, how much cash, ready cash at a given point of time the company has. When we talk about liquidity ratios are concerned with current assets and current liabilities. We do not include the fixed assets and fixed liabilities in the calculation of liquidity ratios. Next, it is leverage ratios. Leverage ratio studies the profits of the company, how the profits can be uplifted, how it is compared with the debt, how we can increase the profitability with the addition of depth in the business. Next, it is coverage ratios. Coverage ratios includes your paying capacity of interest. How efficiently, how promptly you pay interest to your shareholders. Efficiency ratios are your activity ratios, like how much you have produced, what is the stock, how the debts are converted into cash, how efficient the firm's decisions are. It is all included in your efficiency ratios. And valuation ratios, the valuation of the firm. So when for all these ratios, we require profit and loss account and balance sheet of the firm. So this is a balance sheet of a firm for the years 2016, 17, 18, 19 and 20. We have share capital, reserve and surplus, net worth, borrowings, fixed assets, and so on. This is the current assets. If you want to compare the sales, like this, we prepare a statement for income, sales for all the years, raw material for all the years, So here you can see that when you put them in one statement, you can find out that in which year the sales was at its highest. Raw materials required, direct labors consumed, what was the rate of depreciation and the amount of depreciation, what are the other manufacturing expenses incurred, what was the opening stock and closing stock. So this comparative data is available only because you have the information of all the years. All the financial statements are before you, and now you can give a trend analysis for all these years. To start with the first one, profitability ratios, the first formula is for gross profit margin. What is gross profit margin? It is the profit earned during a year to the sales of a firm during the same period. Gross profit earned during a year to the sales. So we compare the gross profit with the sales for a particular firm for the same period. This ratio indicates the gross profit earned by the firm on every rupee of sales. Hence, it is indicative of the efficiency with which the firm produces each unit of output. What is gross profit? It is the difference between the sales revenue and the cost of goods sold. What is cost of goods sold? It is opening stock plus purchases plus direct materials minus closing stock. So this is your COGS, cost of goods sold. So this is the formula. You need to apply this. After gross profit, it is net profit margin. Net profit is, in gross profit, we do not pay tax. It is before tax. But in net profit, we take profit after paying tax. So it is net profit divided by sales revenue. Next, it is net operating profit margin. Net operating profit margin, it is the operating profit to sales. Operating profit to sales. Next, it is return on assets. We need to find out how much return we are getting in our assets. So return on assets, it is net operating profit after tax. NOPAT is net operating profit after tax divided by total assets. So it is net profit after tax divided by total assets. Total assets, it is inclusive of fixed asset and current asset. Next, it is return on capital employed, the capital that you have employed. So these highlighted formulas you need to study under profitability ratio, and then you can do the questions. So this is all formulas fixed with formulas. Now suppose in current ratio, if you want to know what is current ratio is current assets divided by current liabilities. When we include current ratio, when we take current assets and current liabilities, current assets includes all, whether it is a stock, raw material, debtors, cash, bank, marketable securities, prepaid expenses, etc. Same way, current liabilities also includes all. The refined form of current ratio is quick ratio. Quick ratio, we know that in current assets, if you take inventory, inventory is something which will give you money only when it is transformed into finished goods, and then those finished goods are sold to the market. So to know the exact position of liquidity of a firm, we subtract inventory from current assets and then divided by current liabilities. If you want to know what is the actual cash position, where we do not take into account any of the receivables, or stock. Then it is cash in bank and cash in hand and short term investments divided by current liabilities. So, this is the more refined form of your liquidity that at one call you can arrange for the cash. Next, it is net working capital ratio. Net working capital is current assets minus current liabilities, and that the result of current assets minus current liabilities is your working capital, and this needs to be divided by net assets. Coming to the leverage ratios, leverage ratios are designed to assess what proportion of debt and equity has been employed in the business. Leverage means use of more debt in the business so that the profitability of the firm can be increased. So, leverage ratios are designed to assess what proportion of debt and equity has been employed by the firm in financing its operations. Debt funds being the funds made available by lenders who required to be compensated is actual the study of leverage ratios. So debt is what? Where we pay interest. Debt is a long-term borrowed fund, and equity is the owner's share, shareholder's share, or equity shares. So if you want to know the debt equity ratio, it is long-term interest bearing debt. We are taking only debt, and it has to be divided by equity, that is shareholders fund. So debt equity ratio is debt divided by equity, that is shareholders fund. Just a minute. Okay. The next is debt ratio. Debt ratio is long term debt divided by long term debt plus shareholders fund. Next, coverage ratios. In leverage ratios such as debt ratio, debt equity ratio, we need to find out how promptly you are paying the interest. So it is interest coverage ratio. It shows the number of times the funds covers the interest obligations out of which they are to be paid. Efficiency or activity ratios. It is inventory turnover ratio. Inventory is stock. It makes you understand how many times your stock has been used for finished goods. So it is sales or cost of goods sold divided by average inventory. Average inventory is opening inventory, that is opening stock plus closing stock, divided by 2. But if both the informations related to inventory is not available, then you have to take only the stock which has been provided in the question. It can be opening, it can be closing. Work in progress inventory turnover. So it is cost of production divided by average work in progress inventory. Work in progress is the raw materials has been taken for production, but they have not been transformed still into finished goods. Still it is in work in progress. Debtors turnover ratio. In debtors turnover ratio, debtors are outcome of credit sales. So we need to find out that how many times your your sales are converted into credit sales in a particular year. So debtor turnover ratio is credit sales divided by average debtors. We do not take here cash sales. It is only credit sales because debtors arise out of credit sales only. And average debtors, the concept remains the same as it was for average inventory. It is opening debtors plus closing debtors divided by 2. And if opening and closing information is not there, whatever information is related to debtor, that has to be included as average debtor. Next, it is average collection period. How many times in a year you are collecting your debt from the debtors? So it is 365. 365 is the days in a year divided by debtors turnover ratio. So, in order to find average collection period, first you need to find debtors turnover ratio, and then you need to apply the formula. It can be also average debtors by credit sales multiplied by 365. If you want to get the information in terms of month, instead of 365, you can multiply it by 12. Creditors are average, those creditors from whom, creditors are those suppliers from where we have purchased the goods on credit. Net asset turnover ratio, sales divided by net assets. Investment ratios or valuation ratios. So it is earning ratio. When we talk about earning ratio, we need to find the market price of equity share. So market price of equity share divided by earning per share. Earning per share, how to calculate? Earning per share is calculated by using the formula net profit after tax and interest divided by number of equity shares. Total profit, net profit divided by number of equity shares. So market price of equity share divided by earning per share, we're going to get price to earning ratio. And market to book ratio, it is market value divided by book value per equity share. So I think we are done with all the formulas of ratios. You need to apply them in the questions. It's done. All the ratios are given here as keywords. This is a very small block. So we are done with the next unit also, next chapter. Is it clear?
Yes, very clear.
You got the idea about what to calculate and how to calculate. Now the practical part is yours. You have to calculate. I told you that we will be meeting after almost a week for the next class. So when we meet for next class, that time you should come prepared with the practicals. You should practice by this time the practicals, and then we can discuss them in the next class.
Yes.
Okay, you can just go through, recall them what we have studied in this two, then I will come to the next one. I'm just scrolling again from first. You just go through this. What are the contents of inventories? You will have a clear picture of what is work in progress, what is store, what is finished goods. Have you read this? Have you read this? Say yes or no.
Yes, ma'am.
Yes, ma'am.
Okay. So
Yes.
you have written your names in the attendance?
Yes, originally.
Okay. I told you about. Just 1 minute. I'm coming back to that inventories. I'm just giving you these to read. So this is the first one, profitability ratio. Please go through it. This is your profitability ratios, the gist of what it is. Just go through it and then I will come to the next. I'm coming to the next. This is your liquidity ratios. हाँ तो एक बार बस एक बात कर ले गाड़ी शायद निकल रही है हाँ Are you clear with the terms that are used in each of the ratios?
Yes.
This is leverage ratios. Leverage is lifting the profitability with the use of debt and equity. This is your efficiency ratios. Efficiency ratios are also known as activity ratios. Basically, we see in efficiency ratios is that the funds that are provided, are they being used properly or not? The funds are invested, they are giving returns, proper utilization of the funds. These all are being assessed with the use of efficiency or activity ratios. And this is the last one, investment ratios or valuation ratios. Just read the summary. Just just read the summary, then we'll finish off with this chapter. So is the summary clear?
Yes, ma'am.
Yes, ma'am.
Okay.
Yes.
Now then we are moving to the last one. Last chapter of this block. It is comparative, common size, and trend statement. Unit 14, comparative common size and trend statement. That means the financial statements that we have, we are going to make a comparative study, we are going to prepare a common size statement and trend statement. So what this, it says that in order to understand the financial statements of a firm, and if we need to comment on the financial performance of the firm, we need to compare the performance of the firm. And when we compare the performance of the firm, this comparison can be done with the help of ratios. We can compare it over time. We can compare it with the same company, different periods, or with some other firms belonging to the same industry. There are various tools and techniques which are used to compare this. The first one, as we are going to discuss, it is your comparative statement analysis. So, in comparative statement analysis, we are going to take the financial performance of a firm, and simple way we are going to compare it with at least 2 years data. And when we compare the 2 years data, we can easily find the changes between these 2 years. For example, if the sales of previous year was 1 lakh and the sales of this current year is 1,50,000, the simple understanding is that the sales has increased by 50,000, and if it is vice versa, we can say the sales has decreased by 50,000. So when we compare 2 or more than 2 years data, the changes that is noted can be taken into account for further discussion. So when 2 years data are calculated for noticing the changes, such an analysis is called comparative statement analysis. We compare the current year's data with the previous year's data. Am I clear? Whether it is income, whether it is
Yes.
expenditure, whether it is
Yes,
sales,
ma'am.
production, what is the common thing? What is the important part of comparative statement? Here we are comparing the data of only 2 years. Why? Because we need to know the changes of your previous year with the current year. The change can be positive, it can be negative. If the changes are positive, it is good for the company and the company can go for more such changes. And if it is a negative change, the company needs to find out the reasons for this slowdown. So when we talk about comparative analysis, you see here how it is prepared. I will just show you here. This is the comparative analysis of a company, and here it is the balance sheet. You can see here the 2 years that is taken into account, it is 20 and 21. The equity share capital is given and reserve and surplus in the first two rows. So it is, the amounts are in crores. So the first column will be for the previous year. The second column is for the current year. Third column is to find out the change in terms of amount. And last one is to find the change in terms of percentage. So it is known as percentage change. So equity capital is 356 crores and next also it is 356 crores. So can you let me know whether it is what is the amount of change? Is there any change here? Is there, it is a positive change, negative change or no change? Can you please let me know?
No change, ma'am, because it's a 356. It's
Okay,
the
it is
same with
same. Very
capital.
good. There is no
Yes,
change because it is same. So the percentage shown is also 0. No change means 0. The percentage, if it is 0, then the percentage is also going to be 0. If we come to the next one, reserve and surplus, for 20 it is 1245 crores and for 21 it is 1392 crores. So looking into these two amounts, the change is positive or negative?
It is positive.
It's positive.
Okay, reserve and surpluses have increased. So it has been increased by what amount? You can see here the difference is 147.67 crores. So this is in terms of amount. The third column change, it is in terms of amount. Now we want to put it in terms of percentage. Okay. So
Yeah.
1, 3,
Yes.
you need to find this change in terms of percentage. So when it is percentage, you need to multiply it by what? For percentage, we multiply the amount by what number?
100, ma'am.
Yes, very good. It's 100. So just check, are you getting the same answer?
Yeah, yes, we are getting the same answer. Yes.
You are getting the same?
Yes, sure. What I have done is 147.67. That means divided by 1245.00. Then convert into percentages is equal to 11.86%.
Yes, absolutely right. This is the way you have to do. Others also please check. See, 147 is the change when it was 1245. So the difference 147 multiplied by 100 divided by previous year, because 147 change is in the current year. Okay. So 147.67 multiplied by 100 divided by 1245. You will get the answer as 11.86%. Are you getting it now?
Yes. Yes.
Okay. So this part is clear how the calculation is made. Grace, are you doing this?
Yeah.
Understanding?
Yes, ma'am.
Okay, coming to the next. Just
Yes, ma'am.
okay. Now, at least do the calculations till this short term borrowings. Okay. Check the calculations. Is it there or not?
Long-term borrowing is negative.
So did you understood how to do this?
Yes.
Yes. It
Okay.
is clear.
So the first one is previous year, second one is current year. Then you have to find the change in terms of amount, and then the last column, percentage change. The change to be noted in terms of percentage. How to find this percentage? It is the difference amount, the change amount multiplied by 100 divided by previous year's amount. Okay, so income statement is clear. I hope you can do this.
Yes.
Next comes common size analysis. So this is another way to analyze the financial statements. In this, each item of the balance sheet is expressed as a percentage of total assets or total liabilities. Each item is expressed as a percentage of total assets or total liabilities. This is important. So if we are taking the liabilities items, then it has to be expressed in terms of liabilities. And if it is taken as assets item, then it has to be expressed in terms of total assets. Am I clear with this?
Yes.
Okay.
Yes, ma'am.
Last, it is trend analysis. Trend analysis means we need to analyze the financial statements over a period of time. If you want to find a change for 5 years, you want to know that for the last 5 years, what was the position of our sales? What was the position of our production? what was the position of our expenditures in comparison to the sales. So if we go for examining the components of financial statements over a period of time, then the study is known as trend analysis, because we are going to study the trend over the years. Okay, and especially this is done with the items of income statement, like already I said, sales, profits. So for this, already in the first examples also it was same, when we have seen that what was the position for the 5 years. So here you can see here, sales is for 2016, 17, 18, 19 and 20. So the base year, that is the first year, the base year, it is treated as 100. The base year, it is treated as 100. And then each item is expressed relative to the amount in the base year. Each item is expressed related to the amount of the base year. So for the first, sales for the year 2017 is 1957.57. 1957 for 57, and the base year was 2016, which you have taken as 100. In this year it is 1890. So this 1890 is 100. Now we need to compare in 2017, that it will be in terms of percentage, that if 1890 is 100%, what is 1957.57? Am I clear? If 1890.50 is 100%, then what percentage is 1957.57? Am I clear?
Yes.
So we can understand that from the base year, the sales have increased or it has decreased. If it has increased, to what extent, in what percentage it have increased, and if it is a decrease, then what is the percentage of decrease? Am I clear? This understanding is clear how to calculate? Whatever amount is given for the base year, that amount is to be deemed as 100%. And then the amounts which are given for the rest of the years, we need to find it, compare it with 100%. If it is more than the amount of the base year, it will be more than 100%. And if the amount is less than the amount of the base year, then it will be less than 100%. Am I clear?
The explanation is clear, ma'am.
Explanation is clear. Great, thank you. And understanding? What about the understanding?
Both.
Okay, both is clear.
Mm.
Others also please respond.
Yes, ma'am, it's clear.
Yes, ma'am.
Okay. So this understanding and explanation is clear, but you need to practice them. Okay?
Okay,
Okay.
ma'am.
Lot of questions are given, you need to practice them. This they have given why it is helpful. So this is all from my side for today. If you want to ask something, you can ask. I'm just giving my number in the chat box, okay? So in case of any doubt, you can, WhatsApp is there. You all can access WhatsApp.
Yes.
Yes, ma'am.
Yes, bro.
Okay.
Yes, we can.
So I'm writing my number here. And my email. So in case of any doubt, you can mail me or text me. Country code is 91. Okay. So you can save my number and my email ID. Otherwise, also we are going to have one more class.
Okay, ma, for the number, I can see that the number started with 91, then plus 97.
91 is country code, okay? It's for India.
Oh,
My number
okay.
is this.
Okay, ma, thank you.
Okay, so you can take a note of this email and WhatsApp. You can text me.
Hello, ma'am. I wanted to check on the exams.
Exams, Tipulamatso, that I also don't know. That Smriti ma'am will let us know, okay? I think
Yes,
as
I
per
meant to ask to say you.
I will
It will be a
confirm that.
combination of both the reading stuff and the things to solve, isn't it?
Yeah, it will be a combination of your practical questions also and your theory part also.
That is well noted.
Okay.
Thank you.
And reading part is not enough for you, whatever content is provided. So you just text me. I will give you more contents related to the topics.
Okay, bro.
Okay, this
That
is
is not
only a
important.
gist of the content. Or you can explore also. Lot of things are there on the internet. You can explore. If you type the topics, you will get more information, more content about the topics. Mm. You all are known to each other.
Yes, we are familiar with each other now.
Okay. We can have a group also. Okay. Someone please, you can make a group if you have all everyone's number with you. You can make a group and you can add me also so that we can forward all the contents in the same group. A common group, if you have, it will be good.
Okay, we will try to have one.
Okay. So every time if someone misses texting me, they may not get the content. So if there is a one common group, all the contents can be forwarded in that.
Okay, thank you, ma'am.
So today I'm ending the class little fast because we are done. So little early we are ending up. Can we?
Yes, ma'am.
Yes, ma'am.
Yes, sure, ma'am.
Okay, thank you. So we'll be meeting in the next class as and when it is scheduled. Okay.
Okay.
Okay, ma'am. Thank you.
Thank you, Bora. Just I got the idea, so I thought it sharing with all. You
All
can
right,
name it
thank
as
you.
financial management group and then we can have the discussions in that group.
Okay, I appreciate it, ma'am.
Okay. So thank you, everyone.
Thank you.
Thank you so much,
Thank
madam.
you. Thank you.
Thank
Thank you,
you.
ma'am.
Thank you, ma'am.
Okay.